Hello, Jim here. I've been on a journey to learn the right way to trade options to make some extra income every month. And I typically have done that with companies I want to own. Now, on occasion, I will trade an ETF that I don't really want to own. This is the IWM, the Russell 2000 ETF. And I primarily trade it to make some extra income. Today, I want to talk about that trade. It's called an iron condor, how I set it up, what the option chain looks like. So be sure you stay until the end. I think it's going to be well worth your while. Okay, before we jump in, I do want to give a little bit of context. I've been trading on IWM for a long time. I probably have done maybe over 100 trades on IWM. Again, I don't really care to own it, but I'm fine if I do end up getting assigned. But to this point, I've never been assigned to IWM, so it's worked out well for me. It's the Russell 2000. It typically, let's jump over to it typically trades in a smaller range compared to like SPY, QQQ, and some of the other ETFs. Recently, it's been a bit higher than I typically have traded it. I typically have liked to trade it more in the 188, 189 range. It has gone, I believe it's currently right around what, 216. So it shot up big time on Friday, I believe almost $5 or $6. This is the Bollinger Band. So you can see that the top end of the Bollinger Band is right around 222, 223, and the low end is 190. And you can see here's the moving average, the 200-day moving average. So it is pretty high. When you look at it up here, it's definitely on the high end, but it doesn't move. Some other stocks, the Bollinger Band, the tops and bottoms would be significantly higher. So it's been a fairly consistent, somewhat easier ETF to trade on compared to something like the SPY or QQQ. So let's get back into the main spreadsheet. So since this has been so successful for me, I wanted to share it with you guys and talk about why I like to do it. It also helps me decide what other trades I might want to make at the time. So maybe I don't want to do an iron condor. So maybe I'll do a cash secured put, especially if the market's pretty low, or a vertical put credit spread, or potentially a call credit spread. Now, I haven't recently done many call credit spreads, but I might actually look at doing some in the future. So what is an iron condor? It's really what's you can describe is it protects you from if the stock goes way too high or way too low. So you want it to kind of go sideways and not move too much, kind of like what we were looking at here with the Bollinger Band. You want it to move within a range, and hopefully the range would be, maybe 230 and right around, 190 or something. And you want it to move sideways. You definitely don't want something that's too volatile that may jump around significantly. And then what you do is you sell a call spread and a put spread, and they're typically vertical. So you first sell a vertical call, and it's typically a credit spread, and then you also sell a call credit spread. So you actually earn income on both of these spreads. They're called wings, so it's the wings of the iron condor, and it consists of, on both cases, selling a call and selling a put closer to the money, and then buying legs that are farther out, what's called like a long put for protection and a long call for protection. So it allows you to also define the risk. So you don't have as much risk since you're buying that call and buying the put. You can define how much risk you're really taking or what your max loss might be, which you can see here in this image that you can see the actual, as the price goes to down a certain amount, you'll hit your max loss. If it goes up, too high, you'll also hit your max loss. You want it to stay between, in this case, 46 and 54 in order to pick up your gain. Now, even though it says max profit, with any option, if it expires or you're able to close it, if it expires, you end up keeping all your credit that you originally picked up. Now, if you have to close it early, you might not hit the max profit. I typically, when I have closed them in the past, and my most recent trade I did close recently, and I think it was right around a 90% profit. So I was pretty close to this high band. But in most cases, I've just let them expire, so I've gained pretty much all the cash. Now, another reason I look at doing that, I originally moved all my funds from my 401k into an IRA, and I had lots of cash. So the cash is slowly dwindling. And as it dwindles more and more, I'll have less opportunity, and especially when I pick up particular stocks. So as stock gets assigned to me or ETFs, and I run out of scenarios of additional stocks that I want to own, I typically try to not own more than 5% of a particular stock. Now, an ETF, like I do have some SPY, I do have IJH, IJR, a lot of ETFs related to specific indexes. I'm okay with having more of those, but more shares of those particular ETFs. But stocks in general, I don't want to go above 5%. So at some point, I start running out of the stocks I really want to own. And in that case, I start selling iron condors and vertical put credit spreads on IWM to earn some additional cash. So, and like I said before, I'm going to share with you at the end of this video what that looks like, it looks like in the option chain, as well as the setup, how I typically will set up one of these trades. So now what I like about it especially is you can adjust how the iron condor works. So I typically use $10 spreads. So if I am selling a vertical put credit spread and say I sell the put closer to the money at like 100, then I'll go $10 lower. So I'll do a $10 spread. The reverse is true for a call. If the stock's 100 or the strike I pick is 100, then I'll look at 110 for the call I want to purchase. Now for an iron condor, sometimes I'll change that. I do believe the call side is a little bit riskier, especially if you don't own, the shares. And since I don't own the shares, what would happen if the shares get assigned away from me and I don't own them? The brokerage will assign them to me, but then I have to kind of pay those shares back. And it becomes kind of annoying process, and I don't really want to get involved with it. So I would typically want to take less risk on the call side and maybe a little bit more risk on the put side, because again, I'm okay with it being assigned. So I can do that in a number of ways. So I can, maybe do a lower delta on the call side, take less risk on the call side, and maybe do a higher delta on the put side. Or I can potentially do a wider spread on the put side and a thinner spread. So do a $10 on the puts side and a $5 spread on the call side. Again, taking a little bit less risk. That's okay. You can do that. And then it also makes it a lot easier to potentially manage. So in the cases where I've had to manage the positions, and I believe it was last year around this time, maybe a little bit later, I did have to roll the put side of an IWM iron condor down. But I think I only had to move it down one time, and then I was able to let it expire outside the money. So it's not that difficult to manage these wings. You definitely can do it. I have found it more difficult than Fidelity. If you're a Fidelity person, then an iron condor is more difficult to do. I've done iron condors in Fidelity, and I'm typically going to try to let them expire. If I have to roll them or manipulate the wings, then I have to contact Fidelity and have them kind of break it up. There's a relationship between the different wings. I have to have them break that up, and then also break each individual leg so that they're individual option trades, not tied together as an iron condor. So long term, going into the future, I'm going to probably do more iron condors in my taxable accounts versus Fidelity. I also find it a little bit easier to manipulate within Schwab than Fidelity. So I just wanted to mention that, right off the bat. Now, it is fairly easy, again, to manage it, especially in Schwab through Thinkorswim or through the regular Schwab portal. Again, you can roll it down, and I've done instances when I did have to manage it, like the call, I believe at that time expired outside the money, so it just expired. I rolled, so it became a vertical put credit spread, no longer an iron condor, and it later I was able to roll it down, and it also expired outside the money. So, and I'd probably say 90% expired, and maybe 10%, if that, it's probably more like 5%. I did have to potentially roll, and again, typically down. Now, I've come close to having to roll up recently because of the Russell 2000 hitting new highs, and we might run into that more going forward. Typically, with lower rates, the Russell 2000 will potentially do better. And if you think about it, it makes sense. There's lots of small companies that do have debt, and they're not able, some of the bigger companies can better finance their own debt. The debt doesn't impact them as much. That's not true with the smaller companies. So when rates go down and the Fed starts lowering rates, typically the Russell 2000 will do better. A lot of small companies will do better. So keeping that in mind, over the coming weeks, we're going to have a Fed cut this week on Wednesday, the 18th. So I would not be surprised to see the Russell 2000 hit new highs later this week. So just something to keep in mind, or not just this week, going probably into the election. I do think we're going to have some uncertainty related to the election. I wouldn't be surprised to see a continued volatility in the market. We're going to have up some weeks that are way up, like 2 weeks or like last week, and then other weeks that are way down. That happened 2 weeks ago. And I think that's going to continue until we get through the election and past the election, probably. So managing the iron condor, like I said, is doable. It's easier in Schwab than Fidelity. You can still do it in Fidelity, but if you have to manage it, it does require a phone call to the trading desk at Fidelity for them to break it into its individual legs. So that being said, I do want to kind of jump in and show you what this really looks like, share with you an option chain, as well as how I set these trades up. So stay tuned. Let's jump into the next section. Okay, now this is the Fidelity option chain. For IWM, I've already pre-selected October 18th. This is actually a screenshot that I did on Friday, so it could be real data. And I will first look at calls typically. I can either start with puts or calls. But if you look here, I'm looking for, I typically like to do between a 10 and a 12 delta. So I'm looking between 237 and 235 for doing the short. So I can either pick up 96 cents or I can pick up 76 cents. And then I can typically go, $10 out or $5 out. And a lot of times I'll end up picking up probably 70, 80 cents on both sides. So for this swing, I would pick up on the call side, I would pick up 70 cents, or maybe I would only go $4. Even here, I'd still picking up 30 cents or $5, which would probably be around 40 or 50 cents. And, I've gone out to October, so the strike currently 237. If we go back to the Bollinger Band, 237 is pretty high. I mean, I can't even reach it here. So it's kind of like less risky in a sense. So I'm not taking a whole lot of risk with that. But again, with the Russell 2000, potentially with rates being cut, if we have a 0.5% cut, I would not be surprised to see the Russell 2000 get up to maybe 230 or 225, something along those lines. So yes, it seems like I'm a little majorly risk averse, but again, it could reach really high levels if there's a major cut. Now, if we go back to that screen, if I decided to go farther out, I could pick up even higher prices. So I could probably, for the same delta, I could pick up like 239, like if I went out to November 15th. Now, if I went the other way and I looked at September say 30th, I would have to go with a lower strike price, like 233. So the higher the DTE, the lower the higher the strike price on the call side, and it also works like that on the put side. So if we come over to the put, so here we've got the put side. So again, I'm going to be looking. If you come here, you can see on the right where the hand is. I want to look between a 10 and a 12 delta. So I'm looking between 195 and 197, and I can get anywhere from $1.08, take a little bit more risk, do a 12 delta, or potentially bring in around 91 cents. And just like I mentioned before with calls, if I went out to November 15th, I could probably go to 188, even lower. Or if I decided to do a much lower DTE, it would go the other way. To get the same delta, I would not be able to use such a low strike. It would be a lot closer to the current stock price. And again, you can see, so if I picked a 12 delta at 197, we can go back and look here. So 197 is about here. So it is pretty close to the 200-day moving average, which is this red line here. So even though it's up here, this is the 200-day moving average. So I would be more worried if I didn't know we were going to have a rate cut, but there's a potential it could come down. But again, I'm less worried about if I did get a sign, I would probably, sell covered calls close to the money, still make a profit and let them get assigned away from me. So I just feel overall there's less risk on the put side, so I would prefer to go a little bit lower. So it might mean I would take, a little bit less risk. I may do the 10 delta 195. And a lot of times I have stuck to the same delta. So if I did a 10 delta here, I would also do a 10 delta here, which is 237. So I would do 195, 237. Again, let's look at the sheet. So I would do 195, and then I would do 237. And then I would probably use less of a, not as big a spread for the call side versus the put side. Now, with showing you that and why I chose the particular, why I like the 10 or 12 delta, especially with iron condors. I've talked about doing vertical put credit spreads, and I like to do a 15 delta, take a little bit more risk with just doing a vertical put credit spread. But since I'm doing two wings and earning premium from both sides, I'm a little bit more willing to, so here I'm actually going to show you the setup for the trade. I'm a little bit more willing to go with a lower delta because I'm taking less risk on both sides. So in some ways, this is a safer trade than something like a vertical put credit spread. So here you can actually see the setup. This is within Fidelity. This is the trading page. And I've set up buy to open put, sell to open put. I'm doing 3 contracts. I started with 1 contract. If you're a new beginner trader, I suggest start with 1, then you can move to 2 and then to 3. Kind of learn how to trade before you jump in and do too many contracts. A lot of times the other YouTubers will do 10, 20 contracts. I always stick with 1, 2, or 3. I do a lot of trades in different companies, and I prefer to kind of be more diversified than throw too much at one particular company or ETF. So here you can see it's expiring on October 18th. I like the monthly expiration. So the 3rd Friday of every month is typically a lot more volume, a lot more strikes, a lot more open interest. So you can typically pick up some better premium and you have more choices. So here's a 195, 185. This is the 10 delta. So 195, 185. I'd be picking up 91. I'd be paid 91 cents, but then I would spend 43 cents for the protection on the downside. And then on the call side, again, sell to open, 3 contracts, calls. Then again, October 18th, 237. So I'm going pretty far out there. This is the 10 delta. I paid $74 or 74 cents for one contract. That would be $74. Or actually, I sold it, so I would pick up $74. But then I would pay $35 for the protection. So if it ever went above 245, then I would, you know, that would be my max loss. If it went above 245, I would hit my max loss. And that's also why I have a thinner spread. I have 237 and 245, which is an $8 spread versus a $10 spread for the put. So again, taking a little bit less risk. And I could go with a lower delta. In this instance, I picked a 10 delta. And then overall, I brought in 87 cents per contract. So that's how it comes up with the 280. I actually picked the 96, and you might be wondering why 96. So when I have the net bid, midpoint, and net ask, I typically like to take the net ask and then take a couple, cents off that, and that's why I chose the 96. So this trade it would not be filled yet. It's just telling me, hey, this is the estimated credit. You can actually, run the trade, and at this point it would not be filled. If it is filled, then I would make 280. But what happens with Fidelity is once it's in there, I can replace the trade. I can say, well, I'm willing to take 94 cents. So, moving closer to the midpoint, I want to try to pick this up at the midpoint. Sometimes I have to go towards the net bid or go below the midpoint, but I'm typically trying to stay a little bit above the midpoint, and that tends to work pretty well for me. Now, if I wanted to take a little bit more risk, I could make a little bit more. So this is a 15 delta order. So in this case, I'm taking a little bit more risk. This is the put. I'm selling a 200. So yeah, I believe it went from 195 to 200. So no, it went from, well, here, let me go back. Went from 195, 185 to 190, 200. So I'm selling, so sell to open here. I'm picking up 146, spending 61. And then on the flip side for the call, I'm selling the 233. So again, about $5, I believe $4, $5 less than the 10 delta. But I'm picking up 111 and I'm spending 57 to buy the call for the upside protection. And in this case, again, I'm doing a less wide spread. So this is a $7 spread, whereas this is a $10 spread. And I'm paying 54. The net is between 139 and 148. In this case, I chose 146. Again, $2 less than the 148. And I'm picking up $430.20. So this is exactly the type of trade I did recently. And I recently closed one, I think for a total of, I think it was $22 or something along those lines. So I had picked up something similar to this, and I had sold it for around, or closed it for around $20. And this is the kind of trade that I would typically do. Now, sometimes I believe, especially if I'm looking at this, say, next week, and, the iShares has gone up to 226, I may choose not to do the call, and I may just do the put spread and just go with that one. It just switched it. So looking at the iron condor, or starting with an iron condor, sometimes I'll just delete. You can see the little delete button. I'll delete the call, and I may just say, well, I'm picking up 146, spending 61. That may be worth it. Or I could take a little bit more risk with this because, again, I'm okay with owning these shares at this price, and I'll do the call spread instead. I probably do more, or not call spread. This is the put spread, the vertical put credit spread. I typically do probably 3 vertical put credit spreads for every iron condor, but I think that's going to change. I do believe this trade is much safer. The I believe I've done close to 10 of these, and every one of them, again, has worked out really well for me. So this is what I wanted to share with you guys. As always, please hit that like button, subscribe. If you want to learn about my memberships, details will be in the description. I share all my trades. I have the lowest membership is $10 a month. You get a week free. With that, you get access to my trades. I make a trade. Like if I did this trade, I would literally put it into Patreon right after I made it. So you get access to that. You get access to all my spreadsheets. You get access to my collections within Patreon. Now, if you go the next level up, which is $19 a month, you get what's called my Traders Club meeting, and you get everything in Patreon. Then you also get Discord. And I have a lot of members trading in Discord. I have people trading futures, zero DTEs. I have people who are probably much better traders than I am. And then you also get every other week, I have what I call my Traders Club meeting. Last week we talked about income ETFs or ETFs that sell like covered calls and make really good income. The one time before that, I believe we talked about zero TTEs and in futures. Also, I also have open sessions where people can ask any question they might have. And I've actually had members who have shared their screens and actually talked about how they're trading. So, and then finally, I have a coaching. It's currently $25 a month, which is priced way too low. I'm probably going to increase that down the road, but you get 2 sessions on a monthly basis, and that's directly with me. I can do some hand holding. I can answer questions, one-on-one and help you get started if you're just starting out. So hope you enjoyed this. As always, if you have comments or questions or concerns, please leave a comment. I typically will respond within 24 to 48 hours. And as always, thank you for joining me, and I hope you have a wonderful day.